I love educating real estate investors and those who want to get into real estate. The more right now, it's been crazy with the amount of clients that I have that are new, that are coming on board and have from 3 to 5 properties. Today I had a client who had 7 properties and their basis was all incorrect from a prior preparer. So I was really shocked because this guy is a lawyer. So you think, like you're a lawyer, you're smart, and they are. But when it comes to taxes and when it comes to real estate, it's a totally different ball game. And they lost on about $10,000 worth of depreciation expense in 2018. So we had to amend that. So just to give you an example of how important tax preparation and having someone who knows about taxes and real estate is really important. So I'm going to start with just a little bit about myself. So it's me. I work with clients in the real estate niche nationwide. I do everything virtually. I know I have some people on here who have allowed me to help them. My team, all they do is real estate. So we're pretty well knowledge on that. Let's talk about the reason why people invest in real estate. So the number one reason people invest in real estate is to get out of their 9 to 5. Most of them are like, I want to get out of 9 to 5, do financial freedom, so on and so forth. But a huge other advantage that real estate has for this, for people, is the tax advantages. I have seen clients who are high net worth clients who pay more and have no tax advantages because they don't do any real estate investing. So for example, let's take 2 doctors or 1 doctor and 1 stay-at-home parent. And then I look at my clients who all they do is real estate. Those clients who are not investing in real estate pay more to Uncle Sam than real estate investors. So what taxes can do for you within real estate is just insane. Another example, one of my clients, they have about 27 properties. I helped them get the strategy kind of like I did with Felipe, and they ended up getting a refund for about $5,000. The fact that they were able to bring in around $300,000 just of rental income and pay $0. I mean, they paid like 10% effective tax rate, but hello, like I was even mind boggled myself. I was like that was really good. I was proud of myself. Anything, when you're a landlord, so when you're a real estate investor, anything related to the business, once you have a rental property. So I'll go into detail, but I just want to clarify something. There's maybe some people on here, or I have a lot of clients who don't have a business yet. They're thinking about doing real estate and they're doing these mastermind groups and all of these things. Well, if within that year you do not purchase a property, you're not allowed to deduct that. You can continue saving those expenses so I can deduct them next year, but you cannot deduct them if you do not own a property that year. So that is a very important thing that I get a lot of questions asked on. For landlords, so mileage. So if you are doing if you're being your own property manager, every single time you drive to the property, that's a huge thing that people don't even think about. Keep track of it. There's apps out there that are so efficient, and $5 a month that allow you to track your mileage. So also mileage to Home Depot. So if you have to go to Home Depot to pick up something or whatever, anything you can actually link back to the business, which is the real estate, can be deductible. Mile IQ from Diego is a great app. It literally is $5. It's super easy. And at the end of the year, you just send me a report or your accountant, and it's super easy and efficient. Your telephone, you're being the property manager. Even if you're not the property manager, we can expense a portion of that because you need it for your business. Other things are like if you have any subscriptions, now that if you have a business and you start taking classes and you go to the BP conference and things like that, we can start deducting all of those expenses. And there's a lot of people maybe on here, and a lot of my clients who have 9 to 5 jobs, W-2 jobs. Those are the people that, and they don't have any investments. Those are honestly, when I see clients, I'm so blunt. I'm like, thank you for paying extra so I don't have to pay. You guys who have a W-2 job and have no side hustle are the ones, if I were to compare your return to someone who has a side hustle or real estate, you guys are the one paying into the Uncle Sam more than a lot of people are. Maybe not in dollar amounts, but percentage wise, it's those high W-2 workers that have nothing but just 9 to 5. So And these are the kind of things they don't teach you like in school, right? They're like, you have to get out of school, you have to go to college, you have to get a 9 to 5, and everyone goes and follows that thing. And then you realize at the end of the year, you're making $100,000, let's say, and you're like, cool, I'm making 100,000, but I got to pay in 25,000 and I got to go to work 8 to 5 or wake up 6 to 5 or whatever. So those are the benefits that having a side hustle, including real estate, can really help you. Can you provide some clarification to everyone for folks who make more than $150,000? Yes. So I think what you mean is the passive activity losses. Okay. So once your adjusted gross income gets to over $150,000, unless you qualify to be an active real estate professional, that does not mean you have your real estate license. That does not mean that. It means that you have to work in your business more than 750 hours, which meaning if you have a W-2 job and you're trying to be an active real estate professional, you're not going to qualify because there's no way that you're working more on your W-2, on your real estate business than your W-2. If you are, you need to keep really good track of it because the IRS is really puts scrutiny on those people who make over 150 and try to take losses. So here's an example. Let's say you make over $150,000 in regular income, so your W-2 job, and you have 5 properties, and those properties give you a loss of over $25,000, which is what we want because depreciation allows you to get to that point. Now, you are not allowed to deduct those losses. They are saved. They're carried forward until you have passive income. Now, I have a lot of clients who are in this scenario, and this is what I tell them. Cool, that's awesome. Meaning you paid $0 on all that rental income you just received. It was not taxed, and somebody else is paying down a mortgage. You're creating wealth. It's just sitting there until you have passive income. So yes, on a tax perspective, it sucks, but you gotta look at it past that when you can't deduct the 25,000. So I hope that helps, Leo. With cost basis, what should be included outside the initial purchase price? So basis, and I think this is what he means. So basis is a super important thing. This is the example that I gave to you guys earlier today. Basis is exactly, I'm not going to really get into what it is, but I'll give you some examples. So when you purchase a property, let's say you purchase it for $150,000, there's closing costs. There's, you have that closing disclosure statement. That is super important that you give that and you save that to your CPA because I'll be able to determine what your actual basis is. Because most of the time it's over that 150,000. You might have closing costs, you might have some taxes, title fees. Not all is included, but it is really important that we have that. That will determine what your depreciation is. And this is the number one issue with people who think they can do their taxes themselves. I have seen this over and over where they're like, no, I only have one property. It's not that difficult. And then 3 years down the road, they're like, okay, maybe I should use a CPA. Cool. Now I go back and I'm like, well, what's your basis? And now you're selling this property, you depreciated land. Now you have to pay on depreciation. So invest in a CPA, and I'm not selling my services. It's just so important. Like, unless you're really knowledgeable in the real estate world, you can't do your taxes. When you have a W-2 job or maybe 2 or 3, and you have just one house and you have no side hustle, no real estate, use TurboTax. Go to H&R Block because they're going to be more cost effective than a CPA. If you go to a CPA who's a good CPA, they're going to charge you anything over $350 for a personal return, from what I know my other colleagues do. Please use the H&R Block. They're like $100. Once you get to that point where you have a side hustle, you need to focus on what you're good at. And this is a really good example, Felipe, and I'll bring this up because you allowed me to do this.
Yeah.
Tax planning is key. So Felipe had a prior accountant and he did 2 flips. So he thought that he could take that money from a flip and do a 1031 exchange. And I'll explain what a 1031 exchange into a buy and hold. You can't. So at the end of the year, when I'm like, hey, like now you owe X amount of money, he's like, well, I'm like, no, dude, like, why didn't you come to me? You should have told me. You have to do tax planning. Tax planning is key. And a lot of people just are so used to seeing their CPA March 20th, where I'm like, hey, you owe 10 grand, see you later. That doesn't do you any good. It does it, you know, we're providing value by saying, okay, you owe 10 grand because X, Y, and Z. This is what you need to do for next year so you don't owe so much money. Okay, so other questions. Are those miles and property management deductions expenses available to people who house hack? So house hacking is a different, yes, they are. We take a portion of it. So when you house hack, it is a little bit more work because you can't deduct everything from that because you're only renting, you know, 2 rooms, and we're going to have to take square footage of that. But they are allowed. In house hacking, how much are you really driving? Probably not much because your tenants are right there. So, yeah, but they are. Daniel asked if QuickBooks is a good software. QuickBooks is a good software for those who know how to use it. I think Stessa is even better. Stessa is a property, it manages your properties if you have more than one. QuickBooks is a lot more difficult, and I think if I asked Felipe's wife, she would kind of agree. It does take a little more work when you have more than one property to track by class and do things. So I think Stessa is a really good point of start for multiple properties. And then eventually, if you have a property manager, they track everything for you. So you really don't need anything besides the little like miscellaneous expenses. Having a property manager allows you to, I mean, they just send you a report at the end of the year, which is super nice. Do we need a corporation to deduct expenses? Okay, Lisa, I did an Instagram live on this because this is probably #1 question I get all the time. Do we need an LLC to deduct expenses or to even purchase real estate? I'm going to say this, I'm not a lawyer, so please go talk to a lawyer. This is not legal advice. LLCs and corporations are asset protection only. Yes, they will save you taxes and if we do tax strategies, but it is not going to make a difference if you have one or if you don't. But listen to the story that I just heard from one of my colleagues from one of their clients. And I think I'm going to change my mind and just saying it's literally less, unless you live in California or New York, I think you can get an LLC for less than $500. I think you should just put that in your operating expenses and just do it. And the reason is because, so my colleague had a client, he's been in the business and real estate business for about 30 years, never had an LLC in his properties. So he built a $20 million, whatever, portfolio. He was safe. Awesome. He has a great umbrella. Cool. His kid turned 21 years old, got into a car accident while he was drinking and driving, and like either killed or did something to this other poor woman. Well, now the lawyers are savages because they're going to get paid a percentage of how much they get. That now the lawyer is now seeing that the dad does not have an LLC, meaning everything is up for grabs. So where do you think they're going to start? They're not going to sue for $500,000 if they see that his dad has $30 million worth of assets. Now they're suing for everything. So I will say you don't need an LLC to deduct expenses, but I do now feel a little bit different. I think you should just do it. It's worth the $500 that you can go to a lawyer and get it done. It protects you. It puts a barrier between you and your personal assets, if that makes sense.
How does depreciation work with a partner?
I'm assuming what he means is like if you have a partnership, how is appreciation? So it depends the percentage that you have your partnership. So if you have a 50-50, each of you get a K1 and each of you get the depreciation that's for 50-50. However, if you don't have a partnership and you're just doing, I think, oh, hey, do you want to partner up? Give me $50,000. I'll do an investment. Then it would be split again with percentages. I do highly, highly suggest if it comes to working with anybody, including your mother and your father, and I know you love them, get a partnership. Everything is groovy until your mom or your dad get married to some savage that you don't like and they don't like you and they want to take everything from you. So get a partnership if you ever are working with anybody. Don't trust anybody. That's how I feel when it comes to money.